Hello everybody, I hope you are fine. This is the 10th and the last lecture in our International Economics course. In this lecture, we will complete Chapter 26, the Exchange Rate and Balance of Payments. The main points of this lecture are exchange rate policy, financing international trade. Exchange rate policy. Because the exchange rate is the price of a country's money in terms of another country's money, governments and central banks must have a policy towards the exchange rate. Three possible exchange rate policies are flexible exchange rate, fixed exchange rate, crawling back. Flexible exchange rate. A flexible exchange rate is an exchange rate that is determined by demand and supply in the foreign exchange market, with no direct intervention by the central bank. Most countries, including the United States, operate a flexible exchange rate. But even a flexible exchange rate is influenced by central bank actions. For example, if the Fed raises the United States interest rate and other countries keep their interest rate unchanged, the demand for United States dollars increases, the supply of United States dollars decreases, and the exchange rate rises. Similarly, if the Fed lowers the United States interest rate, the demand for United States dollars decreases, the supply increases, and the exchange rate falls. Fixed exchange rate. A fixed exchange rate is an exchange rate that is determined by a decision of the government or the central bank and is achieved by central bank intervention in the foreign exchange market to block the unregulated forces of demand and supply. A fixed exchange rate requires an active intervention in the foreign exchange market. If the Fed wanted to fix the United States dollar exchange rate against the Japanese yen, the Fed would have to sell United States dollars to prevent the exchange rate from rising above the target value, and buy United States dollars to prevent the exchange rate from falling below the target value. There is no limit to the quantity of United States dollars that the Fed can sell. The Fed creates United States dollars and can create any quantity it chooses. But there is a limit to the quantity of United States dollars the Fed can buy. That limit is set by United States official foreign currency reserves, because to buy United States dollars the Fed must sell foreign currency. Intervention to buy United States dollars stops when United States official foreign currency reserves run out. Let's look at the foreign exchange interventions that the Fed can make. For example, suppose the Fed wants the exchange rate to be steady at 100 yen per United States dollar. If the exchange rate rises above 100 yen, the Fed sells dollars. If the exchange rate falls below 100 yen, the Fed buys dollars. By these actions, the Fed keeps the exchange rate close to its target rate of 100 yen per United States dollar. This figure shows the Fed's intervention in the foreign exchange market. The supply of dollars is S, and initially the demand for dollars is D0. The equilibrium exchange rate is 100 yen per dollar. This exchange rate is also the Fed's target exchange rate, shown by the horizontal red line. When the demand for United States dollars increases and the demand curve shifts rightward to D1, the Fed sells $100 billion. This action prevents the exchange rate from rising. On the other hand, when the demand for United States dollars decreases and the demand curve shifts leftward to D2, the Fed buys $100 billion. This action prevents the exchange rate from falling. If the demand for United States dollars fluctuates between D1 and D2 and on average is D0, the Fed can continually intervene in the way we have just seen. Crawling back. A crawling back is an exchange rate that follows a path determined by the decision of the government or the central bank and is achieved in a similar way to a fixed exchange rate by central bank intervention in the foreign exchange market. A crawling back works like a fixed exchange rate except that the target value changes. The target might change at fixed intervals. for example, daily, weekly, monthly, or at random intervals. The Fed has never operated a crawling peg, but some prominent countries do use this system. The ideal crawling peg sets a target for the exchange rate equal to the equilibrium exchange rate on average. Financing international trade. We have seen how the exchange rate is determined, but what is the effect of the exchange rate? How does currency depreciation or currency appreciation influence the country's international trade? We are going to lay the foundation for addressing these questions by looking at the scale of international trading, borrowing, and lending, and at the way in which we keep our records of international transactions. These records are called the balance of payments accounts. Balance of payments accounts. The balance of payments is an organized summary statement of all economic transactions between residents of one nation and residents of the rest of the world that have taken place during a given period of time, often a year. A country's balance of payments accounts records its international trading, borrowing, and lending. The balance of payments is an accounting statement based on double entry bookkeeping. Every transaction is entered on both sides of the balance of payments as a credit and a debit. Credit entries are those entries that will bring foreign exchange into the country, whereas debit entries record items that would mean a loss of foreign exchange. For any particular account, if the credit side exceeds the debit side, we say a surplus exists. On the other hand, if the debit side exceeds the credit side, we say a deficit exists. It's worth noting that a surplus or a deficit can apply only to a particular area of the balance of payments, since the sum of credits and debits on all accounts will always be equal. The balance of payments will always be in balance. International economic transactions are classified as credits and debits according to the following rules. Credit transactions. Those are transactions that involve the receipts of payments from foreigners. These transactions are entered with a positive sign, like exports of goods and services, unilateral transfers, and gifts received from foreigners and capital inflows. Debit transactions. Those are transactions that involve the making of payments to foreigners. These transactions are entered with a negative sign, like imports of goods and services, unilateral transfers, and gifts made to foreigners and the capital outflows. Capital movements are also classified as credit and debits according to the following rules. Capital inflows can take either of two forms: an increase in foreign assets in the nation, which means foreigners' investment inside the country, or a reduction in the nation's assets abroad, which means transferring assets of residents from foreign banks to local banks. Capital outflows can take either of two forms: a reduction in foreign assets in the nation or an increase in the nation's assets abroad. Structure of the balance of payments. The economic transactions recorded in the balance of payments are divided into two broad sections, which are current account and capital account. Current account. This includes visible trade, such as transactions on goods, and invisibles that broadly cover services like tourism, profit and interest, and dividends currently earned on assets held abroad. Also, the current account includes unilateral transfers such as gifts and migrants' remittances, which means transfers of funds. The current account is classified into the following two categories. Trade account includes trade in goods, visible trade, and trade in services, invisible trade. Balance of trade equal value of commodity exports minus value of commodity imports. Thus, if exports of goods exceed imports of goods, the trade balance is said to be favorable, which means a surplus, whereas an excess of imports over exports yields an unfavorable trade balance, which is deficit. Unilateral transfers account. It includes transfers such as foreign aid, gifts, and retirement pensions. These transfers move between countries without involving money in the process. These transfers can be classified according to their source into the following two groups. Private transfers. These are transfers sent by private associations and individuals, whether the recipients are governments or other countries, individuals or private organizations residents in these countries. Government transfers. These are transfers sent by the government of one country, whether the recipients are governments of other countries or individuals or organizations resident in those countries. Most government transfers take the form of aid, technical assistance, and retirement pensions. These are considered debit and enter the balance of payment of the donating country with a negative sign. On the other hand, these transfers are considered credit and enter the balance of payments of the recipient country with a positive sign. Capital account. It includes transactions that don't involve receipts or payments. Receipt of a loan, for example, is not income, but it's exchange of cash now for a promise to pay in the future. The capital account is a record of international transactions involving financial and real assets. This includes investment in real assets abroad, foreign direct investment in the country, trade in securities, which is shares and bonds, between residents in one country and residents in the rest of the world. Borrowing from abroad and lending non-residents, changes in foreigners' accounts in the country or residents' accounts held abroad. Transactions recorded in the capital account can be divided into long-term and short-term capital transactions as follows. Long-term capital transactions. Long-term capital movements include all transactions concerned with real and financial assets or liabilities longer than 1 year. While short-term capital transactions, these are transactions involving short-term capital movements less than 1 year.